Welcome to this comprehensive masterclass on time series analysis. Today, we are diving deep into one of the most revolutionary concepts in econometrics and financial modeling, the ARCH model, or Autoregressive Conditional Heteroscedasticity. Imagine the stock market. It isn't a smooth ride. It has periods of extreme turbulence, followed by periods of relative calm. This phenomenon, known as volatility clustering, is what the ARCH model was designed to capture. Section 1. The nature of volatility. In classical statistics, we often assume that the variance, the spread of our data, is constant over time. This is called homoscedasticity. However, in the real world, especially in finance, variance changes. Think of the 2008 financial crisis or the 2020 pandemic. During these times, the shocks to the market are huge and tend to stay high for a while. ARCH models move away from the static variance myth to a dynamic variance reality. Section 2. The limitations of OLS. Ordinary least squares, OLS, is the bread and butter of regression. It assumes that the error terms have a constant variance. But if you apply OLS to financial data where volatility is high, your standard errors will be wrong, leading to misleading t-statistics and p-values. You might think a variable is significant when it isn't, or vice versa. We need a model that explicitly accounts for the fact that today's uncertainty depends on yesterday's surprises. Section 3. The birth of ARCH. In 1982, Robert Engle introduced the ARCH model, a contribution that eventually earned him the Nobel Prize in Economics in 2003. Engle observed that large returns of either sign tend to be followed by large returns and small returns by small returns. This persistence in volatility is the core of the autoregressive conditional heteroscedasticity framework. Section 4. The mathematical foundation. Let's look at the mechanics. An ARCH-P model consists of two parts. First, the mean equation, where our variable is modeled. Second, and most importantly, the variance equation. Here, the conditional variance, sigma squared at time t, is a function of a constant plus the sum of squared past error terms. If the previous error was large, the current variance will be predicted to be large. Section 5. Identifying ARCH effects. How do we know if we need an ARCH model? We look at the residuals of our linear model. If the squared residuals show autocorrelation, we have ARCH effects. We use Engle's ARCH test, a Lagrange multiplier test. If the null hypothesis of no ARCH effects is rejected, it means our variance is indeed conditional, and a simple OLS is insufficient for our analysis. Section 6. Practical application, value at risk, VAR. Why do banks care? Because of risk management. ARCH models allow institutions to calculate the value at risk. By predicting future volatility, a bank can estimate the maximum potential loss on a portfolio over a specific time frame with a certain confidence level. Without ARCH, banks would consistently underprepare for market crashes. Section 7. Evolution to GARCH and beyond. While ARCH was groundbreaking, it often required many lags to capture the data's persistence. This led Tim Ballerslev to develop the GARCH model, generalized ARCH. GARCH adds past variance into the equation, making the model more parsimonious. Today, we have eGARCH for asymmetric shocks and tGARCH for threshold effects, forming a massive family of volatility models. In conclusion, ARCH models transformed how we perceive risk. By acknowledging that uncertainty is not constant but evolves, Robert Engle provided the tools to navigate the complex oceans of global finance. Whether you are a quant, a data scientist, or an economics student, mastering ARCH is essential for understanding the heartbeat of the markets. References: Engle RF 1982, Autoregressive Conditional Heteroscedasticity with Estimates of the Variance of United Kingdom Inflation. Gujarati D. Non, Basic Economics. Enders W. Applied Econometric Time Series. Tsai R.S. Analysis of Financial Time Series.